It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It is the Jill on Money show, live from the Capital One Bank studios on the far west side of Manhattan. I'm not buying that. What are they calling this neighborhood now? This is not Hell's Kitchen. They're trying to sort of make it be Hell's Kitchen. It is not. I feel like it's like, doesn't Hell's Kitchen end at some point? Is it technically? I want to look at that. I'm going to find out. Anyway, it is, let's see, what is important about this weekend? It is Rosh Hashanah weekend. It is the Jewish New Year. So for those of you who are Jewish listeners, hello. Hello, my brethren. Shana Tova. It starts sundown on Sunday night, I believe. So that's kind of, it's like a new page. I really do like any attempt to turn a page. I do. I think it's a sort of a unique opportunity. So, I find that to be sort of a fun thing. And worthwhile, right? Because it's good to have a reason to kickstart your financial planning, your financial life, whatever that may be. So I don't care what it is. Was it back to school for you? Is it something? I don't know. But I think that any opportunity to sort of say, what's going to force me to just go out there and deal with my financial life? Just something like that. Okay. So I digress. If you've got a financial question, all you have to do is send us an email. The email address here is quite easy. It is askjill@jillonmoney.com. Isn't that easy? Makes so much sense. So send us an email. Give us lots of details. And be sure to be patient because Mark will follow up with you. All right? So we are starting today with Robert, who is on the line from the Bay Area. Hello, Robert. Welcome to the program. What can we do for you?
Well, hi, Jill. How are you?
Fantastic. Tell me,
wow,
what is going
on? Long-time listener, first-time caller. I guess that's kind of a cliche nowadays.
I love that. That's fantastic. How's life? How is life in your? Let me ask you a question. Hold on.
Yeah.
How's life in the Bay Area?
Oh God, it's great.
Yeah.
Everything's up. Well, prices of everything are up. The house market is up. The kids are getting ready to go back to school. The temperature is perfect. The fires are pretty much gone away, but there's still a little bit of heavy haze and smoke in the air. But other than that, everybody's doing great out here.
Fantastic. So tell me what I can do for you, Robert.
Well, listening to you and all these ups and downs on the bull market and then a bear market and then listening to other, people talking about what to do with your money in retirement, I'm a bit confused. I'm 63. My wife is 60. We've been married for 38 years. We have a house that's just skyrocketed in equity. I owe $400,000 with a loan that's 3.75.
Great.
It's worth over $1 million now. A second house in the country that's about 475, but I owe 75 on that at a 4.25%. My outstanding debt is about a $10,000 line of credit, and I've got about $8,000 in the bank. I make good money. I make about $160 a year. Our 401ks, I've got the two jobs. It comes to about close to $820,000.
Great.
And with yesterday and today's market springing, I'm just worried. Should I put it into something safe? I've been in an aggressive fund, and that's pretty much where I wanted to come to you and say, Well, what's your opinion?
Okay, I love this. So here's a couple more questions before we get to the actual allocation of the 401k.
Sure.
On the 160 a year, that's just you, or does your wife also work?
Well, we raised 6 kids, and now my wife is herding 7 grandkids to school, to soccer, to do things
Oh my
for the
gosh,
kids.
she's amazing.
And she never really worked, although she's much smarter than I am. She graduated school and college, and we started a family. And now the 6 kids are raised and got beautiful lives of their own, and are doing quite well. So I've been working 2 jobs my whole life.
Wow, that's amazing.
Yeah.
And do you try to maximize your contributions to the 401ks?
Yes, I have.
Okay, great.
I have 16% in one and 13% in another.
Okay, great. And the line of credit, is it outstanding? You have $10,000 outstanding on the line of credit?
Well, you know what we did a few years ago, as everyone else, I guess, tried to do, was we paid off all of our debt. No cars, no bills, no extravagances. But we got rid of all the credit cards. And so now we just have our line of credit, which is similar. It's in a credit union. And it's similar to just a big old fat credit card. And I can go at my will, and if we wanted to redecorate or put in the lawn, it's $1,200 here, $1,500 here. We could go to there and pull it out. And then we work to try to bring it down as quickly as possible.
Okay. So let me ask you this.
Yeah.
Right now, you're living on how much money approximately? I know you're putting a lot of money into retirement. What would you guess your expenses are? I
kind of figured it out. It's somewhere around $5,000-$6,000 a month.
Okay, good.
And in retirement, if I was to choose to leave early, with Social Security, about, I don't know, I should max out maybe $2,800. And then I've got a small pension coming, which would be about $1,100. So that doesn't really give me a whole lot. I mean, I'm looking to the 401k to maybe help subsidize and limp along, and maybe even keep my little part-time job until I'm really fed up with work. Yeah.
That sounds good.
That brings in a little bit, but not much. But it's a lot of fun, and it keeps you in the know.
Oh yeah. How much is that second job? How much do you earn on that?
It'll be about $16,000 a year.
Okay, great. All right, now hang on. I'm going to do a little math. We're going to go to a break. We're going to pay some bills, and I'm going to do a little math while we're doing that. You sit tight, and we are going to try to figure out the best game plan going forward. And we want to figure out, number one, how much longer you're going to work 2 jobs, whether you really want to call it quits right this second, whether you want to work a little bit more when you really would, basically try to, let's say, milk the cow a little bit longer. How about that? So when we return, we will answer Robert from the Bay Area's question. And if you've got a financial question, it's very easy to get in touch with us. Just send us an email. Ask Jill at JillOnMoney.com. Now, while I'm crunching numbers during the break, you go to the website, JillOnMoney.com, and sign up for our free weekly newsletter. Hang on, we'll be right back.
Have a finance question? There are many ways to reach the show. You can call anytime at 855-411-JILL, send an email to askjill at jillonmoney.com, or tweet a question on Twitter using the handle @JillOnMoney. Just use the hashtag AskJill.
You're back with Jill on Money. This is the program that takes the mystery out of your financial life. If you've got a question, anything remotely financial, anything with a dollar sign, why don't you find out what to do with that question? We'll help you answer it. Just send an email. Ask Jill at jillonmoney.com. Before the break, we were talking to Robert from the Bay Area. He's 63. His wife is 60. They have raised 6 children. Oh, my gosh. They're sitting on a nicely appreciated home worth about $1 million with a very affordable mortgage, $400,000. They've got a second home worth about $475,000, a $75,000 outstanding mortgage. Got a line of credit outstanding with about $8,000, 10 grand on the line of credit, 8 grand in the bank, 401ks with about 820 grand. And so, Robert, let's get back to the issue at hand. First of all, if you were to retire, ideally, let's say at your full retirement age, which is what, like 65, 66-ish?
Mm-hmm.
Okay. And you would consider working that second job just to bring in, say, 16 grand a year.
Right.
So that's good. So you would have that money that's available. So at that time, you would have the $16,000 a year, right?
Mm-hmm.
You would have the Social Security of, you said about $2,800. Is that right?
Yeah.
Okay. And then you'd have the small pension of $1,100. And that would kind of pay most of your bills. That works, right? And then you don't even have to touch your portfolio for a while, which is good.
Yeah.
So that works for me. I like it. I would just say one starter suggestion, and that is that I would like you to have more money in the bank. So between now and the time you retire, the 16 grand a year you're making in the second job, instead of making a retirement contribution on that money, I would stop doing that, and I want you to beef up your bank account. I would like you to have more money in liquid assets. And the reason is that you've got good cash flow right now. You can afford to do that. When people retire, I like them to have at least a year of their expenses in the bank. At least. So what I would like you to do is to take the next few years, and, ideally what I would tell you is that take 16 grand a year and pop it in that bank account every year and beef it up. And so by the time you retire, I want you to have 50 grand in the bank, and I don't want there to be a line of credit outstanding. So I want you to pay that off eventually, and I want you to beef up your bank account, your emergency reserve savings account. Then, when you retire, if you're still working that second job, which as you said, you would like to keep doing that, then you can basically let your 401k continue to grow without tapping it. At some point, you're going to say to yourself, I'm done with the second job. I don't know when that'll be. At that time, the money you're earning from the second job, what you're going to do is you're going to take that money out. You're going to use your portfolio to bridge the gap. And I think that if I'm doing my math sort of kind of right, that it works beautifully. Because you'll probably have somewhere around $900, $1 million by the time you're calling it quits altogether. And you can generate all the money that you need to bridge the gap between your Social Security, your pension, and your needs with the money from that account. This is predicated on the fact that you don't blow this account and do something stupid, which gets me to your original question. How should you be allocating the money? So, how is it allocated right now? The money in both of those 401ks, what is the breakdown?
Well, for our company, company one, my big company, for the 800 plus, it's in a very aggressive mode because after I, lost things in 2000, 2008, I never took it out. In fact, I increased my contribution in the aggressive portfolio, and it grew to what it is today.
That's great.
And my second job, I did the same exact thing, and it's basically large equity with a 60% mix. Small and U.S. equity was 21% mix, and international was 19%.
So no bonds at all?
No, none.
Okay. So here's what you're going to do. If you want to be smart about really trying to manage this, what I would do is at this point, markets, coming off all-time highs, you can say to yourself, well, wait a minute. I'm going to need to tap this money probably 5 to 8 years, right? And if that's the case, I would pull back the risk. So right now, you're 100% in stocks. I think that it's perfectly reasonable to say, let me go to a 60-40. So 60% in higher risk stocks. And again, you can keep the exact same large equity, small, and international. But then with 40%, you should really be thinking about less risky stuff, like bonds. And here's what you're going to give up. If the stock market keeps rising, you are going to give up some portion of that upside. But I don't think that's a big deal, because in your case, what has happened is you've already done the hard work. I've just run the numbers so that if you don't blow it, you've already done the work, and you've made the bold move, which is the 10 years since the financial crisis. You've already done it. So now let's not be a pig. Let's not risk it. Right? So let's take our 100% aggressive portfolio, dial back the risk, and do a 60-40 split. And that will protect a lot of what you've done. And it doesn't, by the way, even if you do that, if you did that tomorrow and the day after the stock market cratered by 20%, you would still lose some money. But you don't need this money right away. That's the other piece. You would still have time to make it back. But what you don't have time to do is to make a too risky a decision. It would really be a shame. It would take away that big risk. And I think you're far better off saying, I'm willing to forego the upside to protect myself more against the downside. So that's what I would do.
Yeah. Now, I've heard a lot about this J.P. Morgan index fund.
Yeah.
And that seems to be...
But listen, any index fund is fine. I don't care if it's J.P. Morgan. I don't care if it's Vanguard. I don't care if it's Fidelity. It doesn't matter what fund you use. But what I would say is this. In your retirement accounts, if you have index fund options, you choose stock index funds and you choose bond index funds. That's how you keep your costs down. So
gotcha.
That to me is what you should be doing. No worries, no fuss, no muss. It's a very boring bit of advice, but you know what? It works. So that's what I would do. It works. All right.
Well, that sounds good. Okay.
All right. Go enjoy your Bay Area and call us back if you've got more questions, but you're in great shape.
Well, thank you so much.
My pleasure. Take care.
Okay, bye.
Bye. That's a good one. There's someone who's going to listen, Mark. So Mark wants to know if you're in retirement already, once you retire, what you do with the allocation. I tend to sort of stick to a balanced portfolio, maybe a 50-50, or stay with a 60-40 is fine. As you approach the time that you need to draw money from your retirement account, the thing that you may want to do is say, okay, I know I'm going to pull, let's just say $2,000 a month from my portfolio. What I like to do is make sure that that money that I need that year is in cash. So whatever you think you need in cash for the upcoming year, even if it's in a retirement account, even if you're already retired, I like to free that up as early as possible. Yes, if the market goes up, you will miss out on returns. But if the market goes down, you save yourself from invading the account. And to me, I'm all about, please, protecting what you have. Okay? All right. Excellent segment. You're listening to Jill on Money. During the break, go check out the website, jillonmoney.com. Mark works so hard to maintain it, and I think he does an amazing job. When we return, more of your questions. We'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
Hey, Mark, what about telling them to connect with me on LinkedIn or follow me on LinkedIn? We forgot to have that done when we do our next round of liners. I love that guy's voice, by the way. You're listening to Jill on Money. And this is the place where we take the mystery out of your financial life. By the way, here also when we're talking about money, it's not scary. It's not boring. We're not pointing fingers. We're not judgy. We don't do that. We just try to give you the best advice that we think is going to help you get on your way. So I'm a certified financial planner. I'm the senior CFP board ambassador. Mark is studying for his CFP certification. This is a message from Randy, and if you've got a financial question, just shoot us an email. Ask Jill at JillOnMoney.com. Randy writes that he's a regular listener, and he's come to our website, Jill on Money, for financial information. He wants us to help him and his wife make a decision on a possible financial transaction. He's got a traditional IRA with just over $1 million. And he says, does it make financial sense to take money from the IRA to increase a share in a family farm? Basically, he'd have to withdraw $250,000 from his $1 million retirement account, pay the taxes, and then he'd have to pay $200,000 over a 5-year time period. He's going to be, he's 67. This fall, his wife will be 65. She's retired. He works part-time. They withdraw about $3,100 a month from the IRA account. And to supplement their income, he earns some money in a part-time job. When his wife files for Social Security, they'll have actually a little bit extra money, and that would be good. And mostly, basically, are in the future, kind of, let's say when he turns 70, they've got it figured out that their Social Security income will be just over $50,000. That should meet most of their needs. We've got no debt. We have some concerns with entering into a transaction of this nature at my age or our age. The other partner to the transaction, 75 years old. Does the financial transaction make sense? Let me ask you this. A couple more questions that'll come back at you. So, number one, is the farmland generating any income right now? Do you already have, you said you're going to increase your share, so you already have a position in this asset. What percentage of your total net worth would be in this overall? Is there any other liquidity? You've got $1 million in your IRA account. Do you have money elsewhere? I'm guessing no. My initial sense of this is that I wouldn't do it, because if the property zooms up in value, you already have a position in it and you'll make money from that. If the value of the land somehow stagnates or goes down, you'd be very unhappy. But most importantly, you wouldn't have access to this money anymore. And, if you were to get sick or your wife needed some help or something happened, I'd want that money. So I think from a pure liquidity standpoint, I would refrain from doing this. I might be missing something. Maybe you're telling me, maybe you'll come back and tell me, oh my God, we make so much money from this thing. But I'm just worried that you don't have enough liquidity anyway. So I'm hesitant to give you the advice to plunge, $250,000, you reduce your nest egg by that much. I don't know. I'm a little cautious. All right, here is a note from Tony. He's 61. He's underemployed. He's making about $20,000 a year. He's got $1.4 million in assets. Well, actually, let's just look at this. He's got $1 million in assets. He's got a $400,000 house with a $250,000 mortgage. He's haunted by the 2008-2009 downturn. He would be devastated if it happened again. Should I take some of the savings and put it in CDs? I realize you don't have a crystal ball. I'd appreciate your opinion. Well, look. How's the $1 million invested right now? You've got $1 million. I wouldn't want it all in CDs. I mean, you got a long way to go before you need to tap your assets. So what I would say is I would be very conservative with that $1 million. I would maybe have at least, a couple $100,000 in really ultra safe, maybe some CDs, short-term bonds, maybe some more in some intermediate term bonds, and a small fraction in the riskier assets out there like stocks. But I guess what I need to understand is, are you pulling money from this $1 million portfolio right now? Do you already have a bunch of money? Just to go to cash because you're scared, I get it. And I get that you're haunted, but you can have a conservative portfolio and have, 70% mostly safe stuff and maybe 30% in stocks. We still have to grow your money. You're only 61. You could live for 30 more years. Bob writes, he's 71. His wife is 70. They're both working full time. How awesome is that? They've got lots of different savings, checking and money market accounts that total about $1 million. They've got 401ks, $1.9 million. We're both collecting full Social Security. He's got 2 pensions, no debt. They just inherited $450,000. It's sitting in a non-interest bearing account. We anticipate dropping about $150 into remodeling projects, which will come from this account. I'm conservative. Some ideas. I love these questions. So he's going to have, well, listen, of the $450, you got to keep $150 available for your projects. Of the $300, if you're very conservative, essentially you can say, I could buy a bond or a CD ladder. I could, say buy something that's a 7-year CD with a low penalty for breaking it. Maybe I could buy like a 4-year, 5-year, 6-year, 7-year. Maybe I could put some money in a short-term bond fund. And maybe what you want to do is just sit on this for a little bit just to make sure that we don't see that $150,000 in remodeling doesn't turn into $200,000. But when you want to have a low risk kind of fear of God and calamity portfolio, those are the kinds of things you look at. You look at higher yielding CDs and money markets, which are longer in term. You look at short-term bonds and intermediate term bonds. You could put some of the money, again, gang, you're 70 years old. You could live for 20 more years, right? So you could put some of the money into higher risk stuff, but don't go crazy. I like the idea of keeping it simple. If you live in a high tax state, maybe consider municipal bonds as well. So fantastic. Good luck, Bob. And if I need more information from us, give us a holler. If you are listening and maybe you haven't inherited money, but maybe you're thinking about estate planning, maybe you're thinking about other financial things, just send us an email, askjill@jillonmoney.com, or go to our website, jillonmoney.com, click on the Contact Us button. We'll be right back with more of your awesome questions.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. All you have to do is send us an email. AskJill@jillonmoney.com. AskJill@jillonmoney.com. Okay, here's an interesting question, because some people, you may not realize this, but let's just go through this. This is from Rebecca, who lives in Washington State. So she's 65, and so is her husband, and her husband is disabled. He may need to be placed in a nursing facility. My question is my IRA secure for me, or does the facility get some of the money? We are 65. I had to retire early to take care of my husband 24/7. Oh, you poor thing. Terrible. It's so hard. Okay. Generally speaking, the state which you reside directs really how this will work, because there's no national plan on this. It all comes down to the state level. I think what you're asking about is your Medicaid, or his Medicaid eligibility. And generally speaking, that you will absolutely have, there are some rules about what is available, what is not available. Okay. So let's say that I don't know how much money you guys have. Okay. But when you apply for Medicaid, or, presumably, you may have to, basically say, here's everything I have. One of the things that's really important is that once it's an IRA asset, it's an asset that it's not a qualified asset. I think it is actually available, since it's available to you. But, and here's the but, I think that what you really need to know is that we've got to look at everything that you have and what you're able to keep. If you go to your state's website, which I just looked up, Washington State Healthcare Authority, you can find out what is excluded and what is not when you apply for your Medicaid. And essentially, here's what they don't count: your household goods and personal effects, one home. So a home, that's like So you would be able to stay in your home. Cash proceeds from the sale of the home, the value of certain sales contracts, and some payments that are coming in. It does not actually exclude. This is the agency excludes up to $6,000 of a person's equity in a non-business income producing property. So all these like weird things here. I believe that this is going to be available as an asset. So I would make sure I go talk to somebody in Washington State to understand the impact of that. But I think it's going to be available because it may not be available if you are under the age of 59 and a half, but I think it is going to be available. That stinks. Here's another question about Social Security and Medicare, not Medicaid. Beverly's going to be 64 this fall, has delayed applying for Social Security. She's got a pension. And right now she is living off her husband's pension and Social Security, her pension, rental income, blah, blah, blah. Anyway, she's got big insurance premium that is due. It's almost $1,000 a month. She wants to know, what about just starting my Social Security at 65 to pay for my Medicare, since it's not a big difference waiting till her full retirement age. And, you know, it isn't, because she has a pension which is subject to a windfall elimination. And so she doesn't have a huge change here in, you know, a couple $100, you know, a month. She says, I like the idea of not having to make quarterly payments to Medicare and just taking it out of Social Security. You know what? Here's what I think, Beverly. I agree with you. The dollar amount is just not enough. And if it makes just the actual management of this then easier, then do it. Just do it. Sometimes you don't have to make the best financial decision, because the best financial decision might be like a kind of more of a pain in the neck than it's worth. So I'm with you. And lastly, here is one that is from William, who's got savings bonds. They pay 1.5%. They will expire in 15 years. Should he cash them in, which will cause his Social Security to be taxed, and invest them in a fund? I appreciate your advice. I don't want your Social Security to be taxed, so don't cash them in right now. Maybe after you're past the period where maybe you could cash them in a little bit at a time so you don't have to cash them all in at once. What you're going to find is 1.5% for safe money right now is fine, but over time, that 1.5% is not going to look so hot. So I might slowly but surely do it. Slowly but surely. Okay? How much time do I have, Mark? Under 1 minute. There's just a quick question here that comes from Paul about getting some advice about Social Security. He was told that a Social Security representative told him something, and he said, hey, I can't find this in writing anywhere. I mean, go to ssa.gov. If you can't find it there, then call back. See if you can get a second person to confirm it. That's often a good way to make sure. All right, you are listening to Jill on Money. If you've got a financial question, maybe it's an estate question, maybe it's a college funding question, ask Jill at jillonmoney.com. And don't forget, we got to sign up for you. Sign up for our free weekly newsletter. You can do that at jillonmoney.com. We'll be right back. You're back with Jill on Money. If you've got a financial question, we'd love to hear from you. Our email address, askjill at jillonmoney.com. Hey, don't forget to go over to the website, jillonmoney.com. You can sign up for our free weekly newsletter and read all the good stuff we do. You can read it, you can listen to it, you can watch it, do all sorts of stuff. It's fantastic. All right, let's finish out this hour and answer some of your questions. You always ask good ones. Beverly wants to know something about a traditional IRA. She and her husband have traditional IRAs. Her husband is the beneficiary of hers, and she is the beneficiary of his. Our son is the second beneficiary. He's a grown man. I think I understand that if I or my husband passes away, the surviving spouse can roll over the IRA into their own IRA. Question, can the son also simply roll over the IRA into his? No, the son has to have something called a beneficiary IRA, and that's all it is. But it holds the tank. It's like a holding tank for the funds. And there are some rules based on whether or not you've started to collect your required minimum distributions or not. But that's really what happens. And it's very easy to do. So no fretting on that one. And when you say that your son is your second beneficiary, I think what you're saying is he's the contingent beneficiary, so that all of the money would go to the spouse. And if the spouse were gone, then it goes to your son. So that's it. Beneficiary IRAs, very easy to do. Any big brokerage house can help you out with that. And let's see. One question here from Tim. Can you invest your required minimum distribution proceeds in a Roth IRA without having further tax obligations? I think what you're asking me is if you could kind of just take that distribution and have it go into your Roth IRA. No. You can only make a Roth IRA contribution if you got earned income or your spouse has earned income. So you can't do that. What you can do is you can pay the tax on your required minimum distribution. And if you're working, make a contribution into a Roth IRA. Or if you're looking to simply evade the taxes altogether, you can move the money from the retirement account and send it to a charity. QCD, a qualified charitable distribution. You can check that out, Tim. Hey, it's the end of the hour. That doesn't mean anything's over for us. It just means that we've got one whole hour to go. So hang in there, and maybe during the break, hop on to JillOnMoney.com, and maybe you can subscribe to our podcast, Better Off. All right, we will be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You're back with Jill on Money. It's time for the interview segments. And here's something fun. When your friends are in the business, you get to invite them on your show. That is what I've done with today's guest, who is a recidivist guest here at Jill on Money. His name is Gary Schatsky, and the name of his company is objectiveadvice.com. He is the chair emeritus of NAPFA, the National Association of Personal Financial Advisors, napfa.org. So that means he is a fee-only advisor, and he's been in the business for a long time. Really does draw a distinction between other professionals like lawyers and doctors and CPAs, and how they really are meant to protect the public. And somehow or other, financial advisors are not in that group. Here's our interview with Gary Schatsky. Let's talk a little bit about the evolution of the industry, which seemed to go from the concept of selling to asset gathering.
Yeah, the key word is seem to.
Yeah, well, asset gathering would be still a salesmanship,
absolutely,
right? But that's what they kind of rebranded in a lot of ways, right? But it's the same stuff. So why don't you give a little bit of an overview of what kind of advisors and financial people are out there for people who are listening to this show?
So you have those that used to completely dominate the field and still do, and those that worked on commission or some other sales approach, whether they were selling stocks or loaded commission mutual funds or insurance products. That's one set. Now many people are morphing into, everyone's an advisor these days, and that word means a lot of different things, where they're asset gatherers, where they're really looking for money to charge assets under management. So they'll charge 1% or 1.5%. They should probably be in jail at that level. These are people who are just putting together accounts, and they manage the account, and they charge a percentage of assets. Frequently, they treat pretty much every client identically. Mm-hmm. Every portfolio is push a button and reallocate it across the board.
Right. Otherwise, they can't scale their businesses.
Exactly. Mm-hmm. I mean, it's a fantastic business model. Mm-hmm. for the business owner. It's not a fantastic model for the client. And then there are, in the 80s, there was, that's when I began, there wasn't even any association that existed. And NAPFA, the National Association of Personal Financial Advisors, was created. And the goal was that people should look for comprehensive advice, impartial advice, and competent advice.
So the National Association of Personal Financial Advisors, NAPFA.org, you rose up and became the chair of the board there, right?
It is true. I was on the board for a number of years, was chair for a couple of terms, stirred many a pot because accommodating others in the industry was less important and is less important to me than accommodating what the public needs.
And so NAPFA today is often known as financial planners who don't take commissions or precluded from taking commissions. But what is it really? Explain it.
Well, that is so much one small part of the picture, because not taking commissions is only one little piece of what the public needs, because that gives you objectivity. But the other part is approaching everything in a comprehensive way, taking a look at your investments and your taxes and your insurance and your cash flow and your 401k options. And many people think, well, I don't know if I necessarily need that. Well, if you care about improving your financial picture, the person giving you advice has to address all of these issues.
It's like going to your primary care physician and saying, you know what? Don't do an EKG. I'm okay with that.
Precisely. Wait, did I say that first? Because
you could take it.
I go with the blood pressure as the choice.
That's good.
But that's exactly it. You can't possibly do it. I have a fever, but I want you to look at my fingernail.
How many members are there of NAPFA right now? About?
I got to tell you, I've lost track of the numbers. It's been growing quite nicely. It's certainly not as high as the public needs. And you might ask, well, why is that? Well, everyone loves, quote, free advice. So the idea behind fee only is that there's a fee, right, associated with it. And so some people figure, why do I have to pay a fee? Others pay plenty of fees. They don't see it. They don't see it taken out of their account. They don't see it in the mutual fund. And in order to practice at this level, as you point out, it's not scalable. So if 100% of your focus is ringing the cash register, if 100% is making the most money you possibly can, this is not necessarily the way you want to go as an advisor. But if you want to do a fantastic job and improve people's lives and earn a fine living, this is the way to go. It takes a lot more ongoing education and time, and cookie cutter is not what it's all about.
If I am looking at the world of, say, a NAPFA advisor, it's not necessarily the case that everyone who would walk into Gary's office or another NAPFA advisor's office has to go through a comprehensive financial plan that's 500 pages.
First of all, the idea of the entire what is a financial plan? It doesn't have to be a book, okay? For me, everyone has a different sort of approach. For me, people are not going to read the book. I'm not going to be there when they're reading the book. I'm not going to be able to meet their objections and their questions and their comments in order to get them to both a level of comfort and to improve their financial situation. But other advisors have a much larger book. In terms of what the fee is, you have so many moving parts in your personal financial picture. Very frequently, someone's going to come into me and say, I have whatever, $250,000, $500,000. And the issue there is how do you allocate those funds? But there are so many other areas to improve their financial life. There could be tax returns where opportunities are missed. There could be debt that needs to be restructured. And these are often you might think, well, these people are missing the boat. Clearly they've never paid any attention. I have a set of clients that are often extremely sophisticated, and they just don't focus on all of these different parts.
Since we last spoke, Gary, there's a ton of stuff going on with this thing called the fiduciary standard. Anyone who is a member of NAPFA is automatically considered held to this concept, which is my client comes before me or my company. Should that be the standard of care for anyone who touches money?
That absolutely should be the standard of care, putting the client first. And let me just back up for a moment, because there's been all this discussion over the last set of years on the fiduciary rule. And when I was chair of NAPFA, I was saying we have to uphold the fiduciary standard. And what did I hear from the board? Very complicated word. People will never understand what that word means. And the point is, the lawyers, we're obligated as a lawyer to a fiduciary standard. The medical community has to put the patient's interest first. If you think you're a profession, if you think you care about the public, doing anything short of a fiduciary standard is selling their interests down the tubes. You have to protect the public. And in the personal financial field, it has been driven by sales, 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 and sales. So they're inching out on the spectrum. Really, they're not going as far as they need to protect the public.
We'll get back to our interview with Gary Schatsky in just a minute. Hey, during the break, why don't you go to JillOnMoney.com. You can listen to past shows, but you can also read, listen, watch, sign up for our free weekly newsletter. It's all at JillOnMoney.com. Okay, we'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
Well, one segment down, many segments to go. We are broadcasting from the Capital One Bank Studios. If I do enough plugs for Capital One, can they get me Alec Baldwin to come on? Was he still their spokesperson? He did all those commercials, and I think he waived his fee. He just said they had to donate the money to Lincoln Center, which is so cool. Actually, I'm not getting a talent fee for this, but I'm happy that we have a sponsor. It might be Jennifer Garner. Let's find out who Capital One is using as their spokesperson. Well, I'll tell you what they're using right now. They're using the Jill on Money show as their central radio strategy, I'm sure. So, yes, we are broadcasting from the Capital One Bank Studios, and we are talking to my friend Gary Schatsky of ObjectiveAdvice.com. He is very passionate about the fiduciary standard, which we've talked about here. And in this segment, we talk about what rules currently that brokers have to adhere to. So here is more of our interview with Gary Schatsky. What does a broker now have to adhere to?
Well, I mean, they have an awful lot of latitude. So the reality is they don't have to give you what's best for you. I mean, each of these words is attempting to give cold comfort to people that someone's out there kind of thinking about them a little bit. But the key word is a little bit. Mm-hmm. And that's not what the public needs. Even the fiduciary rule, when the Department of Labor rolled that out, mm-hmm. people said, well, what do you think about it? I said, if they succeed in making that their big success and then they're done, we have all failed. Consumers have lost because they threw the bone out there that only related to ERISA accounts and a small subset of personal finance. Mm-hmm. And if they think that they've moved it forward and then we can readdress this issue in a few decades, the public is a loser. It's one thing to say, okay, in whatever narrow focus that you're providing advice, that you're going to be doing the best you can. But again, personal finance is personal. Mm. It's not just managing one fixed sum of money. If people don't recognize that there are many moving pieces, their financial life will suffer.
What's the best way that if someone's listening to this, they can feel like, all right, I work with a financial person. Can I just say to that person, is the question really that we pose, are you held to the fiduciary standard at all times? Is that the right question for people to ask?
That would be the right first. That would be the right first question.
Okay, so that's number one.
Right.
Then number two.
When you're giving advice, are you considering my tax situation, my debt, my family situation, mm-hmm. my insurance, all of these different factors?
So this gets us into our last topic today, Gary, one that you love so much, which is a little bit of a deep dive into annuities. I feel like I'm going to just come out and say this. I've said it before. I'm coming out of the closet that I love insurance as a concept. It really is brilliant, right? I mean, I pay someone to take risk for me. Law of large numbers. It all works, right? It's fantastic. So I would say I love insurance, but I really have a tough time with insurance salespeople. So annuities, are essentially insurance products, some of which have lots of different bells and whistles. It's been an oversold product in many ways. It is actually unbelievably allowable to sell someone an annuity inside of a retirement account.
It's outrageous.
I never understood how that is possible, but it's a very strong insurance lobby, I'm sure. Give me the upside first. Like, what makes an annuity an interesting product to you?
Certainty, which some annuities can provide, is attractive. If you're talking about a fixed annuity, which is agreeing to pay you a fixed payment for your life or for 20 years or anything that is fixed and guaranteed by the insurance company, is very comfortable. And people will say, well, I like knowing I have this number. Mm-hmm. And that's probably the greatest single advantage. In other instances, it's sold that it might not be guaranteed, but there are various protections if the market falls apart.
Right. You can pay for those.
Yeah, and you'll pay for them. You might not lose everything. So then what do you walk away with as a customer? You go, oh, well, then I don't have all that risk. You have to quantify to some extent what you're giving up for certain protections. So in the case of a fixed annuity, you might be giving up a much higher rate of return. If interest rates rise again and yet again and yet again, you might be sitting in a product that's pegged to an interest rate that is dramatically lower than where it should be, guaranteeing you a lower payout for the rest of your life. Well, that's certainty, I guess, but not the kind you really want.
Right.
Clearly, I've pivoted from the good news about annuities because it's a shorter story, really.
So let's look at kind of what the alternatives are. I mean, I know also we should just note that most annuities, not all, because now there are some lower cost alternatives,
Absolutely.
Right? The vast majority of annuities that are sold in this country are really expensive, like 3 times more expensive than an alternative portfolio of mutual funds, right?
Yeah, the expenses are staggering. They are absolutely staggering, and it's opaque. You can't even see them. You could drill down on some of the documentation and come up with some of the upfront commissions that go out the window, like before you say hello. And then you have the ongoing expenses that are baked into the products that guarantee you a lifetime of
fees.
Incremental fees. Again, certainty. It's a beautiful thing. Yeah, they are getting a little bit cheaper, but cheap, they're not.
What would you consider using an annuity for a client? In what case you would use that, and what would you use?
Well, it's very rare. I mean, I looked at one just for a fixed annuity for someone who was handling someone's disabled individual's account, and they wanted some certainty about the various payouts. And when you decide to do that, it isn't just a function of go out and get one. You have to, there's a lot of legwork you have to do. You have to price it out. You have to look at all the various players. And there might be a situation, which I said to this individual, you're going to leave likely money on the table by doing this. But as long as you understand that it could be a real sum of money, but you want the certainty, then you could go ahead and do it.
I agree. There are use cases for it. It's really hard to find them, and it's also really hard to execute them, because I think that what happens is a lot of times people get UTSI when something happens in the market. A
financial term, yeah.
Right? And they blow up your plan anyway. They can blow up what you thought was going to be like. They're like, yes, I want a guarantee, I want consistency. And then you're in a roaring bull market, and they're like, I don't like that.
Right. Well, people, there was a time when no one wanted in the market because markets blow up, and now, people think they only go in one direction. If
somebody is pitched an annuity or some sort of cash value insurance product, 3 questions to ask.
Why do I need a cash value insurance product? Do I need insurance or do I need an investment? That would be one of them.
Okay.
The next one would be, why do I need this particular product for insurance for a lifetime, if you're talking about insurance, for a lifetime? Because very frequently people's needs for life insurance tends to go down as you get older. And as you know, it's because the people that you're trying to protect with your life insurance also tend to be getting older. So with a shorter life expectancy of the survivor, you tend to need less money. And third, you tend to self-insure because as you go through life, if you're working, you're putting away money. So you're going to have them kind of explain that. normally you'll get some collection of answers about amorphous tax savings, exceptional comfort, and the inquiry about whether or not you really care for your family.
We just got a call about that. Oh, you're going to save your kids' taxes. I'm like, do you have an estate worth more than $11 million?
Right. What you always hear from the insurance sales folks and a lot of salespeople is they say, I have this whole life policy. My whole family does. And what I say to people, to clients of mine, I said, they don't wake up in the morning, look in the mirror and go, today I'm going to take advantage of a lot of people. They buy into they drank the Kool-Aid,
yes.
Okay? So it's a small subset that think they're defrauding people.
Mm-hmm.
They believe in their product because you want to. If you did something terrible all day, you wouldn't feel very good. So you morph it into something good.
All right. Thank you so much to Gary Schatsky for joining us today. He's always very fun and great to be around and just always illuminating. So thank you so much, Gary. If you've got a financial question, well, we are answering them. So do send us an email. Ask Jill at jillonmoney.com. We'll be right back.
The cure to your financial problems could be just a phone call away. 855-411-JILL is the number to dial. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money live from the Capital One Bank studios, the far reaches of the west side of New York, which Mark says is Hell's Kitchen, but we're not entirely sure if it really is. But I'm going to look that up. I don't know what it would be. Midtown West? Clinton, is Clinton? All right, we're going to have to talk. This is a little inside baseball for New Yorkers. Forget it. Anyway, this is the show that takes the mystery out of your financial life. And while I went on vacation, the emails piled up. So here we are, stuck again. Not stuck, I shouldn't say that, but digging out. So if you are sending an email to us, ask Jill at jillonmoney.com. Please know that we're doing our best to respond to you and to answer your question. Here's one from Bill, who wants to know about buying the 2-year Treasury note from the federal government. Can I buy them at my bank? Can I have interest deposited into my checking account? So here's what I suspect you would want to do, which is what I did. Go to treasurydirect.gov, and you have a nice explainer, which is that Treasury notes are very easy to buy. They're sold in Treasury Direct and by banks and brokers. And you can, probably the easiest way, depending on what you're trying to do, is that you may want to just buy a mutual fund that invests in those notes, unless you have a ton of money. Anyway, in a single auction, a bidder can buy up to $5 million in notes by non-competitive bidding, and then another 35% of the initial offering by competitive bidding. So it can be hard. Your minimum purchase, $100. And so, yeah, I would just talk to your bank or your brokerage firm, if you have one, to figure that out. And remember that the yield is determined at auction. So, whatever you think you're going to get this second may change. Okay? Just know that. All right. Auctions for 2 years and 2, 3, 5, 7 year, they occur monthly. Whereas a 10-year, the original issue, February, May, August, and November. Okay. Hope that helps, Bill. I like that she's buying treasuries, boy. That's a safe bet. All right. What else? What do we got here? Okay. This is an interesting question. A while back, I wrote an article about the trade, and Carol said, I loved your article, What to Know About Trade Deficits. It was succinct. I now have a rudimentary understanding of trade deficits. Still, it's all Greek to me. Does the U.S. have a trade surplus or deficit with Canada? President Trump continually states the U.S. has a trade deficit with Canada, but Canadian Prime Minister Trudeau states the opposite. Is there a definitive answer? You know what I did? I went straight to the source, which is the Office of the United States Trade Representative. And here is what it says. U.S.-Canada trade facts. U.S. goods and services trade with Canada totaled $673 billion in 2017. That's the total, okay? Exports were $340 billion, imports $332 billion, which means the U.S. goods and services trade is a surplus with Canada, $8.4 billion. So it's funny, in this little descriptor, it says, however, the international shipment of non-U.S. goods through the U.S. can make standard measures of bilateral trade balances misleading. So here's the example. It's common for goods to be shipped through regional trade hubs without further processing before shipment to their ultimate destination. This can be seen in data reported by the U.S. and its two largest trading partners, Canada and Mexico. So here's what the president's talking about. The U.S. carries a goods deficit with Canada, and obviously in the services it's different. So that's what changes it. Canada is currently our second largest goods trading partner. So the goods part of it, there is a trade deficit. Services, there is a surplus. The surplus is bigger than the deficit. That's why we have a surplus. So you can't really, you can't extrapolate that. I think that that's true, that there's different stuff that runs through both countries. But I think in general, it is disingenuous of the president to only give you one part of the story. So it's goods and services. The goods deficit, $17 billion last year. The services trade surplus, $25 billion, right? So 25 is bigger than 17. We have a trade surplus with Canada. Okay, there's your answer. That's and as of last year. So it's very important to do both sides of it. Obviously, goods and services, that's the measure of the economy. Can't do one without the other, right? Okay. How much time? Can I do one quick one or not? Okay. Let's see. Here's from Steve. I'll be retiring in a year. I make $70,000 a year. My wife will work $120,000 for a year for another 4 to 5 years. I've heard that you should roll over some of your 401k into a Roth IRA before hitting 70 and a half for tax reasons. Is that something we should consider? Combined, our current annual income is about $150,000 after taxes. We both work. I'm 63 and a half. My wife's 58 and a half. I would wait until you retire in a year, and then essentially what will happen is your income tax bracket or your total taxes will likely go down, because it's just it may not be 100%, but it's about looks to me like you'll go from the 24% to the 22%. And if you have enough money outside of a retirement account to pay the tax due, to convert some of that money from a traditional to a Roth, I would do it. I would not do more than I would only do as much that would contain you in that 22% tax bracket, maybe a little bit at a time. But again, if you don't have the money to pay the taxes, then I don't think you should do it, Steve. All right. If you need more clarification, or if I'm missing something, give us a holler back. You are listening to Jill on Money, live from the Capital One Bank Studios. I like saying that. If you've got a financial question, send us an email. Ask Jill at JillOnMoney.com. We'll be right back.
Wondering how to make your money work for you? Get on the line now. 855-411-JILL. Back to Jill on Money with Jill Schlesinger.
You're back with Jill on Money. And we love hearing from you. And we are trying desperately to dig out of our email inbox, which is overflowing. Some of you might get emails from Mark where he links you to articles that I'm writing for my Tribune column, because I cannot possibly keep up. with just radio show and podcasts, et cetera. I have to actually do something here by getting through these emails. So this is what I'm doing. I'm trying like heck. But boy, you guys got a lot of questions, and I love them. So here is a note from Lee, who's turning 70. He's got a small IRA, $26,000, a Roth IRA with $36,000, and another account with $196,000. So he's got a bunch of different stuff. His current annual income is $35,000. I live modestly. Do you think I can retire in a year and continue a modest lifestyle? I made bad choices with work and savings along the way earlier. I guess if you're turning 70 and you've got Social Security is $1,700 and your pension is $550, if your annual expenses are $35,000, I don't know if I guess that you're saying. I'm pretty sure you're saying is your annual $35,000. If you can live on your Social Security and your pension, then you're okay. And it looks to me like you've got $450-ish thousand. You're going to have to take some money from your IRA when you, after you stop, now that once you turn 70 and a half. Do I think you could do it? Sure. What your goal is to be able to live on a combination of your Social Security, right? Your small pension, which brings you to about $2,250. So I think if you could live on $2,000 a month, then I think you'd be okay. If you need $3,000 a month, yeah, it's close. It's close. It's not, 400. I'm going to do a quick calculation. I mean, you could do it. If it's $3,000 a month you need and you can pull the money out of these two different accounts, one with 196, one with 209, yeah, you could do it. But you're going to have to watch how you spend your money. That's going to be really important for you. So thanks for writing. Good luck. Okay, here's a question from Kathy. She's 89 years old. She's got $1.6 million in Schwab in a private client account. I think she's probably got an advisor. Would you suggest an automatic investment platform? I've heard you talk about Betterment. There's a bunch of them. Hey, Betterment just came in. I just saw a ranking in Barron's of best robos. They don't like to be called robos. And what came in number one, Mark? No. It was Vanguard. Vanguard came in number one. Betterment came in number two. I mean, look, I hate to make a move. If you got $1.6 million in an account and your life is good, I don't know, how much are you paying for that account? Are you pulling money out of that account? Are you feeling neglected in that account? All these are questions I would ask Kathy. I wouldn't move so quickly. Okay? All right. Now, let's see. Here's Rebecca. Rebecca's 76. Her husband's 80. And they've got no debt. Steady income, $10,000 a month. Nice. A bunch of assets. $160,000 from recently sold rental property. It's earning a whopping 1% they would like to invest. We work with a Edward Jones representative. Is there someone else we should consult? Do you have recommendations for the money we have? It's now earning minimum interest in the bank. Well, I mean, if you like the person at Edward Jones, then maybe you should continue to work with that person. If you want to roll the dice and do it yourself, here's a case maybe you would try a automatic investment platform. Or maybe you're just like, I'm living fine. We've got steady income. I don't want to make this too flashy. Maybe the 160 you just literally put in 2 index funds. Maybe you put 70,000 in an intermediate term or short, maybe 30,000 in a short-term bond fund, another 30,000 in an intermediate term bond fund, and 40 grand in a boring extended market index. Maybe you don't want any risk. Maybe you really say, hey, I don't want any risk. I don't want to earn 1%. Well, then go look for some longer-term CDs. We need to know a little bit more about you to try to figure out what to do next. But my guess is that if you're asking me about whether or not you should use this person at Edward Jones, then maybe you have some misgivings about this person at Edward Jones. And if that's the case, then, of course, we've got bigger things to consider. So that's my advice, Rebecca. Maybe you could follow up with a little bit more information. But if you're really worried about the relationship that you currently have, maybe it's time to at least consider alternatives. Okay? All right. Hope that works. Okay. By the way, we've got another broadcast. It's a podcast called Better Off. You can subscribe to it at Apple, Stitcher, Radio.com, Google Play, anywhere else you find your favorite podcast. You can also just go to our website, JillOnMoney.com, and that will give you access to both the podcast, and you can also listen to past shows that we've aired, because Mark's very, very busy. Okay, when we return, more of your questions. We'll be right back. You're back with Jill on Money. And before we close out the program, want to get to one more email. This is from Catherine, who says, while saving money in a 401k sounds like a good idea, the inherent problem is the people managing the money don't actually manage the money so that it both grows and it is protected from being sucked out of the account because the stock market tanks or some other part of the financial markets go haywire. People are not told that they need to self-direct their investments, nor how to do that. They're told to buy and hold for the long run and leave everything to the plan managers. If I knew then what I know now, my 401k would not have lost 50% of its amount in 2008 when the market crashed. Catherine. Catherine, you bring up a few points. One is that, of course, you're responsible for your 401k. And if you didn't understand that, then shame on the plan sponsors for not making that clear. Putting money in a 401k just means that it's basically saving for the future. You are responsible for the investments you make. If your account lost 50% of its value in 2008, it's likely because, you know what? You didn't realize that and you put your money in stock funds. Now, conversely, by the way, if you had just held on, probably you would have gotten all your money back and then some. But it's also a good lesson. I'm not trying to scold you, actually. I'm just trying to remind everybody that when you're putting money into a retirement account, this is your responsibility. You are responsible for the money you put in. You cannot blame the financial system when the stock market goes down. That's why we encourage you to send us an email. If you don't know what you're doing with your 401k, let us help you out. Let us talk to you about your allocation. Let us talk to you about how to prepare for a risky environment. Let us talk to you about how you can essentially protect yourself from being too out there in your allocation, too risky. And conversely, why taking no risk may not be a good idea either. Something in between usually is where you want to go. So, Catherine, thank you so much for that reminder. And I hope you did get a bunch of your money back after the market cratered in 2008 and 2009. Okay, that's it. That is the show. Thank you so much for listening. It has been an absolute delight for me and for us. And when I say us, I speak for Mark as well. If you've got a financial question, day or night, send an email. Ask Jill at JillOnMoney.com. We'll see you next week.